Hello and welcome to the show. This is part 3 of a 3-part series. As I was making part 3, I came to the conclusion that there's a lot of material, so I'm going to split part 3 up into part 3A and part 3B. Okay, so part 3A and B will be talking about shareholders and the short squeeze. And we'll be talking about potential gamma and short squeezes. Okay. Let me start off by saying I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. Let me repeat. I am not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. So let's start. Part 1. In part 1, we talked about the possible Torchlight dividend and spinoff. In part 2, we talked about the company, what the company plans to make, where the company plans to be headed in the future. And in part 3, we're talking about shareholders and squeeze. Okay, so let's start. We saw an interesting tweet by George Palakaris. He said, hey, look, he recently exercised some options and he bought 1.6 million shares. He had to sell a little bit of the shares to pay the tax man, that is Government of Canada. And almost his entire net worth is tied up in MetaMaterials. And he's asking Fintel, IO, and others to please report fully. So apparently he didn't feel that his ownership was being reported correctly by Fintel, and they adjusted their numbers recently, I believe. So let's look at the various shareholders and the owners and who they are, right? So Fintel reports that there are 281 million shares outstanding, and that insiders own 50.8 million shares, which is about 18.07%. And the insiders, they're saying, is about 30 people. Insiders are people who have a lot of knowledge about the company. They might be directors. They might have knowledge that the general public does not have. These are the insider rosters. And if we look, George Palakaris he's a CEO, so of course he knows what he's going to be doing with the company. He's got 3.76 million shares, according to Fintel.io. The next set of people whom I'm calling insiders are Ann Barbara Lambert and Thomas Gordon Welch, and I believe that they're a married couple, and they each have about 22 million shares. Or they have 22 million shares together, so the number gets reported exactly the same. But they are essentially one entity because they're married, right? Next, we have John Berta and Greg McCabe. And Greg McCabe also has Petroleum Corp McCabe. So between the two, we see that Greg McCabe has something like 6.8 million shares by himself as a director. And Petroleum Corp McCabe has another 5 million shares. So he's got about 11.8 million shares there. And John Berta, being the CEO of Torchlight, he's got about 1.8 million shares. So George Palakaris has more shares than John Berta. But again, they all are very interested in the well-being and success of MetaMaterials, right? Because they want their shares to be worth more. Finally, we've got Nadine Geddes. She's got 3.76 million shares. And the last person with over 1 million shares is, I believe, Thomas Lapinski. He's got about 3 million shares or so. Okay, and that's it. Everyone else has less than 1 million shares, but they are considered insiders, so the amount of trading that they are allowed to do is restricted. So, apart from insiders, we have institutions. Institutions own 41 million shares, or 41.8 million shares, which comprise about 14.88% of the shares total. Okay. So when you add the two up, you find that together, there's about 91 million. There's about 92 million shares or so, which comprise about 33% or about a third of all the shares of MetaMaterials. That means that 2/3 of the shares are owned by everyone else, and I'm calling that retail. So what's interesting to note is that insiders and institutions tend to be very long-term holders and long-term players. They typically insiders will be holding for a very long period of time, and they have restrictions on when they can buy or sell shares. It can't be near any earnings times or any quarterly events and things like that. Typically, they are long-term holders. Insiders typically will also not lend out their shares for other people to use. Right, their shares are there, and they're just held. Institutions also have a long-term view, but they typically will allow their shares to be lent out. They'll make a few percentage points by charging borrow fees. So if you wanted to borrow shares, you could borrow them from institutions, in which case you pay them a fee. Okay. Retail has almost no restrictions at that point, right? Retail can buy or sell shares at any point in time, and they are the most free. And they comprise about 2/3 of all the shares. So, in general, if we look at the motivations of owners and shareholders, we generally believe that current prices are low and that prices will be higher in the future. We aim to buy low and sell high, right? We know that management will tend to improve and or grow the company. We hope for the success of the company. And we think that as the company becomes more successful in the future, the value of the company will be recognized by future shareholders, right? We think more people will wind up saying, hey, that company is making a ton of money. I want to buy that because I can see that their earnings are increasing, they're growing, they're hiring more people, that whole thing, right? So that's what owners and shareholders believe. So what do shorts believe, right? And what is shorting a stock, right? In general, people who short stocks, they sell stocks that they don't own, and they sell them directly into the market to drive down the share price. They hope that by selling the stock price early, that at some point in the future the stock price will be much lower, and that they can buy back the stock at that lower price and recoup in profits the difference between the price at which they sold and the price at which they will in the future buy back. So when they sell the shares, they have a liability immediately, and they know that they need to buy back those shares, right? Now it's really hard to sell things that you don't own, so they typically will have to borrow the shares from people who do own the stocks, and they'll pay the borrow fee, right? And they'll do that in order to sell the shares into the market. Now, there's another type of shorting called naked shorting, and they don't even bother to borrow this. They don't even bother to borrow the shares. They just sell what are called synthetic shares directly into the market, right? And they have a liability to pay for any to buy back that stock at a later point in time, and to pay for any dividends or any disbursements from that company. So how does this actually work? Let's look. We'll put 3 people on the screen here. We'll call one person Ms. Loner. She's got a bunch of shares ready. Mr. Short, he has no shares, and there's Mr. Buyer. He wants to buy shares, but he also has no shares, right? So what happens? Mr. Short, he borrows a bunch of shares from Ms. Loner, right? She lends her shares, and she gets a borrow fee for that. So Mr. Short has some shares that he borrowed. Now, Ms. Loner hasn't actually sold her shares. She's still got her shares, but Mr. Short has borrowed them. So he owes a debt to repay those shares back, right? Anyway, he sells those shares directly to Mr. Buyer. Mr. Buyer has brand new shares. As far as he's concerned, he's happy. And Mr. Short owes the shares and the dividends to Ms. Loner. So Mr. Buyer walks away. He's got his shares. He's perfectly happy. But Mr. Short owes a debt of shares and any future dividends to Ms. Loner, right? Because her shares have been sold to Mr. Buyer. So Mr. Short owes a debt. He's got a liability, and that's the open short position. And at some point in the future, he hopes to buy back the shares from somebody else, from some other shareholder who sells their shares, and cancel his debt. And that's called closing the short position, right? Once the short position is closed, if the price of the shares are lower, then Mr. Short has a profit, and he pays his taxes on that profit, right? So the shorts have certain motivations, right? They want to sell high in secret and buy back low sometime in the future because they believe current prices are way too high. They hope for the public failure of the company, right? They want the company to basically crash and burn. And they believe that they can convince other shareholders that the company has no value, and they can induce maybe a panic sell, right? They want to lower the price as much as possible and buy back the shares that they previously had sold, right? As a bonus, if the company goes bankrupt, if the price of the stock goes down to zero, they'll never have to buy back those shares. And they can leave that short position open forever, which means they can avoid paying taxes on their gains, right? Which is quite interesting. So they can actually make a lot if they actually can push the price down to zero, and that's where they eventually want to get to, right? So let's look at the risks, right? If you open a long position, if you buy stock in a company, what are your risks? Well, on the upside, the price of the stock could go to infinity, right? The company could grow to such an extent, it could hire so many people, it could be thousands, tens of thousands, millions of times what you bought, what you bought for. Think of Apple, right? People bought Apple for like $5 a share, and it's gone up and split and gone up and split and gone up and split, and they've become multimillionaires as a result of just buying a few shares of Apple, potentially, right? On the downside, the company could, the price of the stock could go down to zero, and you could lose everything. So you could lose 100%, right? If the price of the shares goes down to zero, at that point, you've lost 100%. So that's your potential downside as a long. You can get a large gain, and you could lose everything, right? Let's look at the short position, right? With a short, you sell immediately. So if the price of the share goes to zero, that means you've made 100% profit, right? You can't make any more money than that. That's it. That's the most you can make, because you eventually have to buy back the shares, and if you buy back the shares at zero, whatever you sold the shares at initially, that's your profit. So the most you can make is 100% from one short position, right, that you've opened. Now, on the downside, if the price of the share goes against you, it could go up towards infinity, which means your share price could go towards infinity, and you could be owing something that is cost you way more than what you ever than what you ever signed up for, right? So shorting a stock means that you can lose a lot more money than whatever you originally invested, right? On the other hand, there's an old saying that a lot of retail investors know about. It's that the market can stay irrational longer than you can remain solvent, right? You could know everything about a company, and you could know that company is crap, but you could see the price of that stock going up and up and up and up, and you can get margin called, and you could lose a lot more than whatever you could potentially gain by shorting it. So that's why retail typically does not short a stock, right? So how do shorts make greater than 100%? What do they do, right? I just said previously that shorts can only make 100%. Well, typically shorts make more than 100%. What they typically do is that they open up a new short position after the price has dropped, right? So they keep opening up position after position. And as a result of opening up new short positions after new short positions after new short positions, it's possible that you can get greater than 100% of a company's stock to be shorted. Right? That means that more stock has been sold than actually ever existed. And if that happens, then shorts are in trouble, because at that point, if the stock price ever starts going up, and they've got those short positions, they have a potentially large amount that they have to wind up being responsible for and being liable for. So there's an old saying called short and distort, which is the exact opposite of what's called a pump and dump, right? Short and distort is a type of a scam. A pump and dump is a type of a scam. What people do for short and distort is they first sell the stock short in secret, right? Then they spread rumors about corrupted, incompetent management. They say there's financial irregularities. They spread rumors of possible delisting of the company by regulators. Who knows, right? In general, they keep spreading bad news after bad news and rumors and speculation. And they hope to drive the price of the shares down, because people, they'll say, hey, sell your shares now before it's too late. And a lot of people get scared, and they sell, and that causes the price of their shares to go down. And then the shorts repeat again, right? Until the share price goes to zero or the company gets delisted. And at that point, they don't have to ever cover. So, the other interesting thing is we can see how much short interest there is. We can see how much shares have been sold short in the market, because twice a month, the short interest actually has to be reported. And here we see that you can go to the NASDAQ website and you can see the short interest of MetaMaterials. We can see that it's updated twice a month. It's not updated daily. It's updated twice a month. So that the data could be a little bit old, and in fact, it most likely is old. The earliest that you can see is 15 days ago, typically, right? So at best, you're looking at old data, and the short position might, at that particular moment in time, the short position could be much higher than what you're seeing, because it's only reported twice. But anyway, there's a lot of data that's reported, and it's typically reported in this column type format, right? Where they say what the settlement date, the short interest is, and the average share volume, and the days to cover. So I don't know about you, but looking at a bunch of numbers in a column doesn't make a lot of sense to me. So I like to make a graph. So I took the data from MetaMaterials, made a graph out of it, and that made much more sense to me, right? I can see the dates on the bottom on the x-axis, and I can see what the short interest is. And over time, I can see, hey, the short interest has been growing, right? That may not have been obvious by staring at a bunch of numbers in this columnar format, but put it into a bar graph, you can sort of see what's going on. And we can see that it's gone up to about 30 million shares of short interest, and in general, it goes up and down, right? So I shrunk the table down and had a look at the short interest and compared it to the price of the stock itself, and looked at the volume indicators of it for the stock. And I noticed a very interesting correlation, and I think you will probably notice this too. So when the price of the stock is increasing dramatically, and then suddenly it turns around, you can similarly see that the short interest, which had been relatively steady for a while, suddenly increases and goes high and remains high. That's what I call a short attack, right? So you can see that shorts have sold into a rising share price. And when you see the short interest increase dramatically like that, that means that shareholders aren't selling shares into the market. They're not causing the price of the stock to dump. That's a short attack. The short interest has increased dramatically, right? So you can see that happened on around 221. Around 226, we see that the short interest increased dramatically. We saw that the share price also at that point in time dropped significantly as a result of the short interest increasing in price. When else did this happen? Well, this also happened here at 6:30. If we look at that time frame, at the end of June, we see that the share price was heading up dramatically, and then suddenly, what happens? There's a huge spike in short interest, and again, shareholders aren't selling at that point. Those are shorts selling directly, shorting into the market. They're selling shares that they don't have, hoping to borrow it back later at some point later on. So they've increased the short interest, and they have dropped the price of the share. They've actually sold so many shares into the market, right? We see that the volume spike increased dramatically at the same time that the short interest increased dramatically. So that volume isn't from people who are selling. The volume spike increased early in June because people were buying, right? We saw that, and with that volume spike increasing dramatically and the price increasing dramatically, we saw the price was starting to head upwards dramatically. But then the shorts attacked, and they attacked with so many shares that the volume spikes also remained high just from the short interest, just from the short attack, and that caused the price of the stock to go down. We see this happened again. As the share price was increasing, we saw that the shorts continued to try to suppress the price. They increased the short interest, but they weren't able to stop it quite so much, right? The share price still increased a bit. So they continued to try to suppress the price, but they didn't. We see finally at that the volumes had dropped off significantly. But there's a large amount of short interest. And what does that mean? That means that people weren't selling. People weren't buying or selling. So if the shorts were to actually close their short positions at that point in time, they would increase the price of the stock dramatically. So they didn't want to close their short positions. They kept it open. So you see a high short interest here. And we see that it would be difficult for the shorts to cover at these prices without dramatically increasing the price because the volumes are so low, right? So as a result, they had to keep increasing their short position. And finally, at 12:15, you saw an increase in the short position, possibly by Kerrisdale or other shorts, and that caused the price of the stock to go down again. But the price of the stock isn't going down because shareholders are selling. It's going down because the short interest is increasing dramatically. Okay? So we see that increases in the short interest can have a downward pressure in price. Right, and that's because the shares are sold directly into the market and they push the price down. So, what about a decrease in short interest, right? Should a decrease in the short interest result in an upward price pressure? Let's have a look. We look at the chart and we see decreases in short interest, but we don't see a corresponding increase in the price. At least I don't. And what that means is that a decrease in short interest has no effect on the price. And why is that? If an increase in short interest can cause the price to drop significantly, why can't a decrease in short interest cause the price to go up, right? Because a decrease in short interest, you would think, is, the shorts buying back the shares that they had previously sold. They're buying back shares, right, you would think, from other shareholders and canceling out their debt, right, canceling out their liability. The answer is that this really never happens, right? The shorts just claim that the short position is closed, but they're not buying back shares. What really is going on at this point in time? What's going on is that they're buying derivatives. They go into the derivatives market and they buy calls, which limit their downside risk for a particular point of time, right? And then they get a cash infusion from a bank or an investment bank or a brokerage, and that prevents margin calls. So now they have a large cash position, and that can prevent any margin calls from the price of the stock going up, hopefully. And they bought calls, and that can limit their downside risk for a particular moment in time, right? And then they're claiming, the short position is closed. But it's not really closed. It's all that's really happened is that they've temporarily limited their liability, right? They've temporarily limited their risk. But they're still stuck. And that ends part 3A of shareholders and shorts and possible squeezes, okay? Come back for part 3B. We'll go over what the derivatives market looks like and what kind of games the shorts are playing there. So let me end by saying I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. With that, goodbye.